Hi everyone, welcome back to another episode of Providend's Money Wisdom Podcast. I'm your host, Isaac, Associate Advisor at Providend. Joined with me today is Chye Hsern, who is here again to discuss about Providend's portfolio construction. Hi Chye Hsern.
Hi Isaac.
One crucial role that Providend's investment team does is to construct portfolios for our firm's investment solutions. So could you briefly explain what portfolio construction entails?
Right. Portfolio construction at Providend is basically helping the client asset allocate their capital into a set of different asset classes, typically here stocks and bonds, that will be overseen by Providend and in a mix that will help them achieve their life goals, their wealth plans, without taking on a risk that they are uncomfortable with. So we would be, for example, looking at say allocating a certain percentage of the client's capital to stocks, a certain percentage to bonds based on certain expected returns that we think are reasonable for that asset class, and then giving the client a mix that will not give them too much volatility such that they will not be able to sleep comfortably while investing in that portfolio.
Yeah. So let's talk about fund managers. So at Providend, we mainly use Dimensional and BlackRock funds and Vanguard ETFs to construct our portfolios. So could you explain the rationale on why we use these fund managers?
Yeah, great question. So that's the next level of portfolio constructions. After you decide the asset classes, then you have to decide how to implement your exposure in those asset classes. And at Providend, we're not fund managers, so we work with the asset managers who will be investing the money directly to select the appropriate funds to use to get the exposure that we want to those asset classes. Yes, as you mentioned, we work with three managers currently. We use Dimensional funds for a large part of our portfolio. For index exposure, we use iShares or BlackRock, and then we use Vanguard also for index exposure. We actually do use some other managers for smaller exposure that is also index based for very specific exposure such as Lion Global and also Nickel Asset Management. Yeah, we use certain index strategies that they run also. So as you can see, most of our focus on managers are either extremely systematic through Dimensional or index.
Right, so you mentioned that Dimensional is a systematic fund manager. So why do we choose Dimensional specifically to do the systematic tilting towards value, small cap, and profitability factors?
Yeah, so a few things that we consider. First of all, we go back to our investment philosophy and framework. So first of all, yes, they invest in stocks and bonds. So from an economic contribution standpoint, what they're investing in makes sense. And the next one is really empirical evidence, which is where Dimensional is very strong at. So first of all, when you look at the data, empirically it does show that there is a value premium. Over time, if you invested in value stocks versus growth stocks, and Dimensional defines value stocks through the price book, that they feel that that's the best metric to determine whether a stock is value or growth, you would get a slightly higher return over time. And similarly, for investing in smaller companies versus large companies, you would get a slightly higher return over time. And so what Dimensional has done well is that they have created a solid framework and implementation that allows them to create portfolios that are extremely diversified, but yet have run specific tilts towards these premiums or these factors, so to speak, that allow you to get some exposure without losing the overall diversification of the portfolio. And they are able to do this in a manner that is very cost effective. Their funds are not high priced, they are very competitive with index funds. So from this standpoint, we felt that working with Dimensional does provide our clients a good investment experience. And I think that was highlighted in the last couple of years. In fact, when we first started with them, the portfolio slightly underperformed the market, underperformed our index portfolios because value stocks and small cap stocks were not doing so well. If you recall back to prior to COVID, it was the large tech stocks that were doing extremely well. But since late 2020, we saw value stocks have a turnaround and catch up. And in the last few years, even in 2022, we saw a strong outperformance from the value and small cap tilts that we had with Dimensional. So they've been consistent and shown that they are doing what they say they will do, and that's why we are also comfortable using them for our equity strategies.
Right. So behind the scenes, actually, the investment team do a lot of monitoring of this, whether the fund managers are actually sticking to their mandate, whether they are capturing the value premium. So far, based on your team's analysis, has Dimensional effectively captured the small cap and value premium?
Yes, they have. Well, you can see from the fact that during the years that growth stocks did better, they were underperforming. So we know that they were in value and small caps during that time. They were not, chasing growth stocks.
They may be underperforming, but they are doing their job.
Yeah, I mean, so that a manager is doing what they say they'll do when they underperform when their strategy is supposed to, But during times when value did well, which is critical, right? They did outperform. So starting August 2020, we started to see value stocks outperform, and from that period on, we could see our positions outperform. In particular, the targeted value fund, which is a small cap deep value fund that Dimensional have, that we allocate a small part of our portfolio to. It's hugely volatile, but in the last 2 years, it has delivered extremely big outperformance versus large caps.
Chye Hsern, are there any alternatives to Dimensional when it comes to systematically tilting towards factors of higher expected returns?
Yeah, there are definitely alternatives. Or I would put it as there are definitely other managers that run similar strategies that are looking to capture factor returns. There are other managers like AQR, Avantis, even BlackRock, and other large managers that traditionally run index funds or actively managed funds. They also have systematic smart beta strategies, if you call it something like that. Yeah, they do have all these strategies. So there are plenty of different managers out there that run similar strategies, and we are always on the lookout for alternatives, or rather always on the lookout to see which manager is doing a good job at running such strategies and consider them for our portfolios. But then it comes down to the next implementation and practical considerations. A lot of these managers don't have their strategies available for retail in Singapore, and so that makes it more challenging for us to implement it in our model portfolios for clients.
Right, so that's our investment framework in action in a sense.
Yes.
Okay, so let's dive deeper into equities and bonds. Let's start with equities first. So in our previous episode, you shared that we globally diversify our portfolios. And we do so by sticking close to market cap weighting of global stock indexes for the equity components of our portfolio. So that is, as of today, around 60% in the US, 30% in developed ex-US, and 10% emerging. So could you briefly explain what market cap weighting means in a global sense, and why do we weight it as so?
Okay, thanks for that question, Isaac. So what market cap weighting means, market capitalization is basically the value of a company. So it's like number of stocks times the stock price that will give you the market capitalization of a company.
Right.
So market cap weighting for a country would just means all the companies on that stock market added together, there'll be the market cap of the country's stock market. So market cap weighting globally just means that you follow the sizes of the various countries' stock markets essentially, and then you just weight them accordingly. And the US by far is one of the largest, is the largest capital market in the world, so that's why they have such a huge weight. And yes, actually, emerging markets is a bit more interesting because the index providers, actually China is a huge onshore. The companies in China actually have a very large market cap also, but I think because it's not so easy for foreign investors to access, that's why they only consider the sort of offshore capitalization of the companies. So emerging markets is a smaller allocation to sort of a globally diversified portfolio. However, within the emerging market space, China is definitely a very, very large allocation.
Right, and so why do we use market cap weighting? Like, let's say someone wants to invest and he has 100% in US equities. So to get international diversification, maybe he'll put, should I put 20%? Should I put 40% into international stocks? Why do we believe that we should stick to what the market cap of the global stock market is when it comes to diversification?
Well, market cap is just an easy way to just sort of gauge where the market is pricing every single stock market at. So I mean, if another country were to suddenly become the largest capital market in the world, that would mean that that's where all the capital flows are going. So it also just is a factor of liquidity, because the larger the market capitalization you have, the more liquid that market is. So it will be easier to have that as the bigger weight in your exposure in your portfolio, because you don't want to have 100% of your portfolio in a very illiquid market. Then that would be very challenging if anything were to happen and you needed to either access that liquidity or to make adjustments to your portfolio. So we think that the market capitalization is a function of sort of the market price for liquidity, and that's just an easy way to allocate your portfolio and diversify your portfolio.
Right, so we trust market prices to do the global diversification for us in that sense.
You can think of it like that, yes.
Right, so for all our portfolios, no matter what currency it is denominated in, it is left forex unhedged. So for example, though a portfolio may be denominated in SGD, its underlying holdings are held in the stock's local currency. So could you first briefly explain what forex hedge and forex unhedged means, and why do we leave equities forex unhedged?
Yeah, good question. Well, hedging for FX exposure basically just means that if you were to say hold your base currency is Singapore dollars, and you were to hold a company that's listed in the US in US dollars, you would be hedging that forex exposure, I guess, buying forward contracts or sort of futures contracts to make sure that whatever happens, the value of your Singapore dollars that you invested today in US dollars wouldn't change, right? However far in the future you are trying to invest for. So that's sort of FX hedging in a nutshell. So why we don't leave it? Do we leave it unhedged? Sorry. Because hedging, first of all, there's a cost to hedging. There's a cost to hedging FX exposure, just as is a a cost to hedging any kind of position. And secondly, the volatility of the equity market or equity returns is far larger than the volatility of FX. So over time, the return from your equity will far outstrip whatever FX movements that you have in the portfolio. So there is not much value to be gained from hedging the FX in the portfolio. Also, our portfolio is so diversified across the entire globe that if you were to hedge every single currency back to Singapore dollars, you'll be running fairly large hedging costs. And that is also not very practical for the portfolio, as a lot of your returns will be eaten up just hedging the currency. So that's the reason why we are okay with the equity positions in a portfolio being unhedged.
Right. So in the event that a country's currency plummets against other major currency, so for example, the GBP, pounds, after Brexit. So how would an unhedged portfolio behave? If let's say I buy a fund that is denominated in GBP, and the currency plummets against, let's say, the US dollar. So how would the portfolio behave in that way?
In that situation, that portfolio would look like it's making big gains in pounds, in GBP, because the currency that the fund is reporting in is GBP. But if it's holding a lot of stocks that are denominated in US dollars, if nothing moves, right, the currency gain would be very big, and they would be looking at good returns in GBP. But of course, when you translate that into US dollars or into another currency, the gains wouldn't look so big. I mean, they would just look more normal, I guess. Because you're taking out the currency movement from that return.
Okay, moving on to bonds. So what is our view on bonds when it comes to portfolio construction? And in contrast to equities, why do we hedge it to the currency that is invested in?
So for fixed income or bonds, we focus more on lower volatility and on certainty. We use bonds in our portfolios to stabilize the portfolio in times of equity market stress. So we don't want the bond portion to be too volatile. So we would sort of prioritize safety or quality over yield. So we won't be going into high yield. We won't be buying large positions in like BBB bonds. We would prefer to have at least a reasonable allocation to A and above, and also we make sure that we also have a certain focus on managing the duration. We don't want the duration of the fixed income to be too high, so that should yields move in higher, we minimize the capital, or rather the mark-to-market movement of the fixed income in the portfolio, because there's already enough volatility in equity. So we want to try and use fixed income to reduce the volatility of the portfolio, so that clients can stay invested and not panic if markets fall. And to the second part of your question on the hedging, fixed income volatility is lower than FX volatility. So it makes sense to ensure that your fixed income is hedged back to the currency that you are investing in, because if not, you can see an entire year's or even more worth of returns wiped out by movements in the FX. So it is important to hedge your fixed income back to the currency that you're investing in.
Right, so Chye Hsern, just now you mentioned about duration. So why is the duration of the bond important when it comes to investing in bonds in our portfolios?
The duration, very simply explained, is basically how much the price of a bond will move when interest rates go up or down by 1%. So if your duration is sort of high and interest rates move up or down, the price of your bond will move up or down by a lot. And for example, in 2022, when interest rates went up, that meant that bonds, longer term bonds, which have a higher duration, basically fell a lot more in a mark-to-market basis. So that adds a lot more volatility to the portfolio, because you would suddenly be looking at big sort of drawdowns in also not just your equity, but also the fixed income portion of your portfolio. And that's something we try to minimize, because we want clients to be able to stay invested long term to capture the asset class returns. So if, say, clients saw big drawdowns in their portfolios and they really decided that they can't handle the volatility and sell their investments, that would mean that, like right now, when markets are up and bonds have recovered, I think bonds are up about 3+% so far this year. So, the client, if they were, unable to stay invested and they had to sell, like say late last year, then they wouldn't be having a very good experience, because they would also be missing out on the recovery. So we're going to try and minimize that.
Okay, so prior to 2022, I remember within the industry, a lot of people were going for either lower credit rating or longer duration to squeeze out any form of yield. I mean, at that point in time, yields were close to zero. But Providend stuck to shorter duration bonds even when interest rates were rock bottom, at least prior to 2022. So what gave you that conviction to maintain Providend's shorter duration bond funds for lower risk portfolios, despite going through an extended period of really minimal yields? Like, why do you stick to keeping it to a short duration bond?
I guess, we can fall back on Providend's philosophy of sufficiency for life planning. We were focused really on the objective of reducing the volatility in the portfolio to fixed income, rather than chasing higher returns and yield. And we use the equity exposure in our portfolios to capture that, or rather to get that return. So that allows us to also tilt the portfolios to the small caps and value, which do add a little more volatility to the equity part of the portfolio, which is why we also want to make sure that the fixed income is lower volatility. So for those reasons, we were good with staying in short-term bonds, even though yields were low.
You get a lot of questions from clients asking, hey, Chye, why are we still sticking to this? It's giving us very low yields, and if let's say we get a 10-year bond, it's yielding at least 2%. So how do you explain to clients?
Yes, we definitely got questions from clients about why we are investing in these bond funds and the yield is so low, and why don't we do something else? But I think we always go back to the client and explain, we can invest in something that would give you a high return, and show them the scenario, but this would entail a higher risk. And are you okay if your portfolio falls this much? And most of the times, the clients would after that understand that it's not such a good idea to invest in something that gives a higher return on paper, because if things go the other way, then they wouldn't feel comfortable at all.
Right. Okay, so thank you so much, Chye Hsern, for your time today, and thank you for your insights. It's really eye-opening to see how Providend's framework, your investment framework, really informs even the portfolio construction every step of the way. That's all for this week's episode. I hope you enjoyed our discussion on how Providend constructs our portfolio. If you like this episode, please follow our podcast and follow us on social media for similar contents. As always, thank you for listening, and I'll see you in the next episode. All analysis, views or opinions from interviews, recommendations and other information broadcasted, or published herein are provided for general information purposes only. Information expressed does not take into account any specific situation, particular needs or objectives, and should not be construed as specific advice or a recommendation. Information has been obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed. Always consult with a qualified investment, legal, or tax professional before taking any action. Providend Limited does not accept any liability for any loss whatsoever arising from any use of the information broadcasted, or published herein. All contents and information contained herein may not be copied or reproduced in whole or in part by any means without prior written consent of Providend Limited.